Hello traders, welcome to another video here in Rubber FX. This is the only channel you're going to learn stuff that will turn your trading around from losing trader to a winning trader. In today's video, we will be looking at internal and external liquidity and how smart money use this to move the market around. If you understand this concept alone that I'm sharing with you here, these are pure premium content, okay? It will add value and confidence to your trading. What are you going to learn today? You're going to learn how institutional order flow is being moved around within the market and what you should be doing when you have internal break of structure and what you should be doing when there are internal liquidity. So first of all, what are internal liquidity? Internal liquidity are simply liquidity that are being generated within a trading range. Now, this is a trading range. Your high that breaks the low, creating a new structure. That will be your trading range. Okay, so you mark out your trading range first for you to understand what internal liquidity is. Okay, then this move from this high to this low is called an impulse. Okay, this is the impulse leg that creates a break of structure. You can see we have this move down, lower low, lower high, then a new lower low has been formed. Now, while this lower low is being formed, it created some form of internal structure. Okay, starting from the lower time frame to the higher time frame, then we get this break. So we have internal structure. This internal structure gives birth to liquidity. Okay, all of these are liquidity, and they are within this trading range. So as long as they are within the trading range, we call them internal liquidity. Now, external liquidity, on the other hand, are simply liquidity that are outside the trading range. Okay, if you have a form of liquidity above here, for example, that is external liquidity. Yeah, these are external liquidity, including this I. This I now serves as what? An external liquidity. Okay, anything below this trading range is also external liquidity. For a downward move, the market reach for what? External liquidity to create a new leg of structure. Take note. Now, this pullback here, this pullback is called a correction because the market must create form of what? Pullback. This is how the market operates. It goes zigzag up and down, creating what? Impulse and corrective leg. So, now the pullback as well also create what is called what? Liquidity on its way up. Okay, in this case here, the institutional order flow shift for the short term to what? Bullish. In this case here, the moment you fill up an external range of what? Structure, POI, for example, like an order block or supply zone, the market shift in what? Institutional order flow to become what? Bearish. Because we are bearish, we will jump into this trade and take the trade to the downside, targeting this low here. Okay, and once the market shifts what? To bearish, it prints liquidity while going low. A bearish order flow simply means the market is interested in the lows, okay, while the highs are being protected. If you don't understand what it means, I'll put the link in the description for you to see institutional order flow. Okay, I want to use this video to explain how you trade this internal and external liquidity. Okay, now when the market is going for a pullback, okay, the job of a pullback is simply to clear some of this liquidity, tap into a favorable supply zone, and then continue the trend. So this pullback on its way up is targeting the high. The institutional order flow is what? Bullish here, up until we have that internal break of structure. Okay, so now what are the duty of internal and external liquidity? Why do you need it for? Now, number one, you need the internal liquidity for intraday and scalping target. Meaning, if I'm to take this trade here in a lower time frame, okay, maybe I enter there's a good setup, because this change of character will happen within the lower time frame market structure. So if I'm entering this trade here, I can use all of this liquidity here as my target for intraday or scalping. If I'm scalping for a quick 20 pips, 10 pips, this might be my target. All of these lows are my target. Okay, all of these lows will become my target. Why? Because I understand that they are what? Liquidity. Internal range. From this high to this low, they are internal range liquidity, which I can easily target. Okay. Likewise, for trading pullback, if I'm to trade a pullback, because pullback is very difficult to trade, you don't expect to hold this pullback longer. Okay. The best place you exit your trade is to exit at the internal structure liquidity. Okay, internal structure liquidity. These are best place you can easily quickly take a scalp for a counter trend opportunity, and you take out your trade at internal liquidity because they are internal, because they are trading within that range. Now, number two, what I use it for, because I'm going to share just two with you, too powerful. Number two, I'm just going to share two. This is the first one. The number two here, they provide liquidity for the point of interest. Now, when you see liquidity before any point of interest, for example, that point of interest should be considered a high probability point of what? Interest. Okay, like if I want to continue this bearish move, all I need to do is to wait for price to clear all this liquidity that has been generated. Okay, clear all this liquidity, and then I come into this trade and then aim for the external liquidity. Those are the ways you use it. Okay, you wait for the liquidity to be taken, tap into your point of interest, and then you move. Now, most people make mistakes by trading the order blocks within this, within the range, between this range, internal liquidity. When you trade order block, yeah, these are the order blocks that will give you headache. They won't hold because they are at the pool of liquidity. When you see order blocks within an internal liquidity, you trade with caution. Though if you are trading there, make sure you are just scalping. Okay, make sure you are scalping, because 9 out of 10 times they don't result to a continuation of what? The trend. So these are order blocks you should be avoiding. Order blocks sitting at liquidity pools. Okay, that is why you need to understand internal liquidity. Why the external liquidity is great, because when you see order blocks seated at external liquidity, they push price. Okay, this is the external liquidity here, and you see an order block here. This serves as a high probability order block. So take note, OB at external liquidity are high probability OB. Okay, as I said, the beginning of the trend of the trading range is an external liquidity, and an OB at that point is what has a higher probability of success rate. So this is an example for a bearish move. The same thing happens for a bullish move. Okay, we have an impulse leg creating a range. Okay, so anything within that range, any leg of structure within that range is internal market structure, which provide what? Internal liquidity. Okay, and when market change order flow, they becomes what? Target. Okay, they becomes what? Target. In this case, the market will push higher. Most people want to be trading an order block in here. Most people taking another block in here because the institutional order flow is what? Is bullish. This order block will not hold. Okay, this order block will not hold. Why? Because it's sitting at the pool of what? Liquidity. Now in this one we say, is this not external liquidity? Yes, it is, but at the reversal point it will not work. Okay, so you target those highs. Those becomes your target because it's a weak low. Now this order block will not work because it's a weak high. Yeah, a weak high. Weak high in the sense that it didn't break structure. The purpose was to clear this structure, but the moment you don't see that, that is the exemption to this rule here. Even though it's sitting at external liquidity, the fact that it didn't break structure makes it what? A weak high. So a weak high is always a target. Okay, so when I'm moving from here, this becomes a weak high, and then you expect price to take that. Now price will trade low to where? An order block that have external liquidity above. In this case here, you can start trading because number one, the order block is seated at what? Discount zone, because you are going to use all the concept that you know, premium and discount, to assign probability to those order blocks, okay, and see which of these order blocks will hold. This is just an hypothetical illustration. I will go to the chart and explain to you what to do. Now, how do you trade this? Now, to trade this, you need to understand, number one, change of character. You need to understand change of character, okay, or shift in order flow. Because we are looking for a bearish move for this example, yeah. The market has already broken structure, yeah. Now, this returning leg is simply what? A pullback. Now, the moment you see a change in order flow, especially in the lower time frame, tap in at an order block that has been mitigated, or a supply zone that has been mitigated, and you see a change in order flow, this is a strong signal that we might be heading for what? For the lows. So when you see a change in order flow, this is a signal for you. This is the kind of confirmation that you are looking for to start targeting the lows, because the aim is to clear up all this internal liquidity till this external liquidity is taken to form a new leg of structure. Okay, now for the pullback as well, you also need a form of what? Change of character to take this price up to mitigate your high probability point of interest to continue to move down. So this is what I want to share with you. If you have any question, put it in the comment section. Okay, put it in the comment section. I'm trying my best to make you understand this. Now, the external liquidity is simply our target. Okay, when you are entering here, you target the external liquidity. Now let's quickly look at these examples here. Let's look at this idea. Now I'm going to look at this. I'm not going to look at all this. Now, looking at this place here, now let's look at this example. We have this high trading this leg of structure here. So this is our trading range. This is our trading range. This is our trading range. So now, any structure within this trading range are called the internal market structure, and therefore the internal market structure provides internal liquidity. Okay, now what you need to be doing is to identify those internal liquidity. One is here, this is one, because when price is coming up here, you need to target this. Okay, you need to target this because these are equal highs. Now your best area to start shorting from are these zones here, this order block up to this point here. Now this high here is a protected high or a strong high because it led to a break of structure. Okay, so you don't expect price to come up and clear that high. Okay, now take note, when you look at this, the market started moving up, changing the order flow to what? Bullish, but creating what? Internal liquidity. All of these are internal liquidity. Okay, so now if you see an opportunity to take a trade here, for example, this was a good opportunity here. If you go to a lower time frame, this is the weekly time frame. I don't want to go to it will be noisy, but if you go to a lower time frame, you start hunting for a selling opportunity. Okay, and you can see this created a break of structure here. This is change of order flow or change of character. Okay, the moment price does this, all this will become your target. Okay, you can start entering from here, having a long-term picture that you'll be going short. This is a good way of knowing your directional bias from the weekly. When you understand the weekly chart, it can help you minimize losses by knowing which side of the market you'll be trading. The moment market start creating all of these, because if you go to the 4-hour here, it should give us a change in order flow. Now I can't go back to the 4-hour because trading view did not allow me. Okay, but you can see this is the area here. All of these are simply weekly internal liquidity. You must attach a time frame to it. All of these are weekly internal liquidity, which serves as what? Targets. So the moment you start entering here, you see your setup, you start aiming for all of this flow, because the order flow now shifts what? Bearish. Start targeting all of this. Now, while you are targeting all of this, there will be some trading opportunities for a quick scalp. You should know what you'll be doing when you are buying here now. For example, you are only scalping. You are not expected to take this trade and start continue breaking those highs, because they are simply liquidity. Okay, so that is how you trade them. You target all these lows here. Target all these lows. As you can see, market start targeting those lows. And there are some areas that push price up, just to also clear some of the internal liquidity being created here. Clear some of the internal liquidity here to form more orders to push price lower. Then eventually we have a break of structure here. Okay, so you need to understand your internal structure liquidity and then external structure liquidity. So this is the leg that created this break from the weekly time frame. Now everything inside here are simply liquidity. They are simply liquidity. If you are not careful, you think this is a break of structure here, a leg that breaks structure in the daily, but you end up seeing price moving low. If you know that this was a liquidity, internal liquidity, you'll be scalping. Okay, you'll be scalping this market, because the market hasn't returned back to the point of what? Origin here. Now, I'm not saying every time it returns back, but in this case, it went back. Okay, then from here, once it gets here, you can start launching more for itself, and this becomes your target. This is the external liquidity where you'll be targeting. Okay, and all of this serves as what? Your internal liquidity, because it is trading within the range. Okay, the range from this high to this low. So anything inside, this is in form of pullback, provide liquidity. Then while the market was providing this impulse leg, it also provides liquidity in form of what? Internal liquidity here above. So if you are trying to sell from here, okay, you have to apply wisdom. You should know that, okay, this is a beautiful trade for you to take, but you know where you are exiting, because market might even try to trade what? Higher, because of the weekly time frame. Okay, so once you understand this, you are going to eliminate some trades, and when you eliminate trades, it gives you a higher win rate, because those trades actually might lead to losses. Give a higher win rate, and then you know exactly what you'll be expecting when price mitigates at the point of origin. If you want to understand more on institutional order flow, I'll see you in this video.